Hi everyone. In this video we're going to be looking at the chapter 8 homework exercises here, and as per usual I'll let you all just do the drop down questions yourself based on your notes, etc., and let's jump more into the actual work problems here. So in tab number 2, problems 2 to 4 exercises, we're going to use the following information and round to the penny, so we just have 2 decimal places. Okay, on the first of the year, and that's typically important when we're looking at depreciation related problems, is that you always need to see when the depreciable asset was purchased, because if it was purchased, for example, on November 1st, we would only have 2 months of depreciation in that given year. And we would need to use months too in that instance, because you'd want to be recording 2 months if you were just doing one entry at the end of the year, for example. But if we have a purchase that happens right on the very first day of the year, then you can just use the number of years instead of the number of months, because typically you might need to look at the number of months if it's asking to see what the depreciation is at a certain point throughout the year. But if it's asking you to just calculate the depreciation expense for the whole year, since it was put into service on the first of the year, you'll have a whole year's worth of depreciation to record. Okay, so we've got a piece of equipment, $50,000, 8-year life, or this is 100,000 unit life. So whatever it is, we looked at certain examples of units for depreciable items, like miles for a vehicle or number of copies for a photocopy machine, etc. Whatever it is that kind of wears down the equipment, depreciates it. Excuse me. And a salvage value of $5,000. And so here, pretty basic, we'll put our formula in. So I'm going to say $50,000. Make sure I get 50, yeah, 50,000 minus our salvage value. And we're just going to use straight line. And like I mentioned, we're doing the whole year, so it's pretty easy. Just divide by 8 years. Oh, typo in there. So I'm just going to copy that same. You could really copy the same one. You could even just link up to above. Because as long as you're just accounting for a full year's worth using the straight line method, then you're just going to continue to have that same amount of depreciation continuously until the asset is fully depreciated. Okay, so let's see here. Okay, exercise 3. So now we're going to use the units of activity method, and it tells us that 10,000 units were produced. And for the depreciation rate, I'm going to copy the same formula, the very similar straight line, but instead of the number of years, we're going to use the units life. So that was 100,000, which gives that 45 cents, and then the same. So then we're doing 10,000 units times the 45 cents, and it was the same. Oh, why did that not work? Sorry. That was 2,000 the first year, and then 25,000 the second year, not the 10,000. So let's just paste in this formula. And again, just if you guys see me doing the Control C is copy. So if you wanted to copy this formula, you go to the formula bar, highlight, Control C. I hit Enter just to move out of the selection box there. Then you highlight into this, Control V to paste, and then you get that same formula that was the answer to this one, but instead of 10,000, this one in the second year was 25,000. So that gives us the whole. It just depends on the number of units, basically, is where you have to come up with that depreciation rate. And same formula, right? Residual value. Historical cost minus the salvage value. Sometimes you'll hear residual value used in place of salvage value. Same thing, just a different word. And then here we're going to use the double declining method to calculate. So the first thing we do is put in our beginning book value. And then remember, for the double declining, we just want to use the historical cost, not the salvage value. And then to figure out the depreciation rate, we're going to take what would be, so think about, see if I want to say this. The answer is not going to go away here when we calculate, but typically if we were talking about depreciation rate at the beginning of a year, we would be using, it's 1/8 of the whole value being depreciated every year using, for example, the straight line method. So in double declining, then we just replace the 1/8 with 2/8. So that gives us a quarter of the depreciation is going to come in this first year. And to figure that out, we just multiply those. Not times, we want to divide. Oh no, that's right. Okay, there. So multiply it through. 12,500 depreciation expense. Accumulated depreciation in this first year is just the same amount as the depreciation expense because we've only accumulated 1 year's worth. And then here's kind of a different thing here with double declining. So we bring down the updated book value now as our beginning book value. We're still going to have the same depreciation rate. That's going to be the same every year. This formula, we just carry that down. That's just going to take our 25% times the beginning book value. Then the accumulated depreciation will be the prior accumulated depreciation plus depreciation expense. And then we get the ending book value. All right, what am I missing here? Oh, sorry, beginning book value minus total accumulated depreciation. And then we just kind of do the whole same thing again. So then you bring down your ending book value. I have the formula in here, so that just takes the multiplication of those two. Again, I can just drag this formula down. So we're going to take our prior accumulated plus current expense. And then we go to the total historical cost minus the accumulated depreciation. So that's one thing to watch out, is you're always going back up to the very beginning when you're getting ending book value there. Bring it down. Do the same thing basically. Drag your, you can really do this well with formulas. And then again, there we go. And the one thing to keep an eye on, it doesn't haunt us here in this problem because we're not getting to the end of the depreciation. But what you will run into is if you fully depreciate using the double declining method, you may have to adjust the final year's worth of depreciation expense just to make it work so that you end at the salvage value of $5,000. So it doesn't come as neatly as the straight line method, and you might have to calculate depreciation expense and then manually adjust it so that you end up at $5,000 as an ending book value, the salvage value in this instance. And you have to do some kind of like manual adjustments. Again, it's sort of everything within depreciation is an estimate. And so it's just kind of further highlighting that fact that we have to do some manual adjusting at the end, but it shouldn't be anything that would be material. So just something to keep in mind. All right, that's the process, and we'll move on to the next tab. Okay, in this problem on tab number 6, we've got a bunch of different transactions that a company paid when they were buying some land, tearing a building down, and then beginning to build a new building. And so we're asked to kind of classify the accounts that would be used for these specific transactions, whether those would be land improvements, building, or other. Okay. So in this one, it tells us we paid $500,000 to buy land worth $300,000 and a building worth $200,000, but we're planning to demolish the building. So the full amount of the purchase is really just for the land because we're getting rid of the building, and so we're going to put the total amount of the $500,000 paid in as land, as that's essentially what we are purchasing since we're getting rid of the building. Then we paid $100,000 to tear down the old land. So again, it's or sorry, tear down the old building, so getting the land ready essentially for construction. We received $25,000 back for old materials, so that's just kind of an offset to the one above it. So it reduces it, so we're netting the expense to $75,000 there. On 12/31, we paid $25,000 to fill and grade the lot, so that's the land, work to get the land ready, and then another $5,000 was paid, or sorry, $50,000 was paid to lay sod and plant trees, and so that's going to be land improvements. It's kind of things on top of the land, essentially. Paid $50,000 to build a retaining wall, pave a parking lot, and put in sprinklers. Again, that's going to be improvements on the land as opposed to the land itself, or the building specifically. Then we paid $75,000 to dig a trench for the foundation for the building, and $1 million to construct the new building. So both of those are going to be costs specifically related to the building's construction. During construction, we paid interest on a loan as we're working to, back in terms of the construction. And so we're going to capitalize that interest paid. Whoops, not 450,000. Get rid of a zero there. But 45,000 total. And that's every one of the transactions, and then we add those all up at the totals, and here's what you get. So really just comes down to kind of understanding these different categories and being able to look at the types of expenses and classify those appropriately. All right. So let's see here. We've got one second here. Another problem, so we purchased a machine for $19,500, so $19,500, and a salvage value of $1,500. And we're gonna do, that's our life. And here is where, like we talked about previously, we bought this on 4/1. And so the fact that we bought this on April 1st means that we need to click that through. We'll come back and finish the problem here. It means that we need to figure out the monthly depreciation and then figure out how many months that first year is going to contain. So if we think of it starting on April 1st, maybe it's easier to think of what months aren't included. So January, February, March. So 3 months out of 12, you didn't have the asset. And then 9 months out of 12, you did. So we can take our cost minus salvage value, divide by not the years necessarily, but the months. So it's 50 years is the same thing as 60 months. And so this is monthly depreciation. Then if we take the divide by 60, but then we're counting for 9 months, like we just said, in that first year. And so 2,700. And then in the second year, it will have been in service for the full year. The first year was only in service for 9 months. So we're not using 9 months. We're just using 12 in this instance, 12 months total if we're using a monthly factor. Or we could just get rid of the monthly part, because now we're just talking about years, and we could say divide by 5, which would be the same thing essentially. Okay, now let's look at our units of activity method. So again, I'm going to just kind of steal this formula, get rid of the time factor though, or the amount of months there, and divide instead by the total number of units of activity, so 120,000 to 15 cents. And then let's take this amount and multiply it by 20,000 hours in the first year. And then we'll take that same formula, and in the second year it was 30,000 hours. All right, so now we're going to look at the double declining method. So remember that we don't use salvage value, so ignore that. And then to figure out our depreciation rate, we take 2 divided by, because it's double declining, so 2 divided by the 5-year life. And then we take, and we're going to have a little bit of a extra factor here that we need to take into account. So we're gonna do the historical cost times the depreciation rate. Remember, if we just multiply these together, that's the annual, but we have to do only 9 months in the first year. So we're going to additionally have we need to multiply by 9/12 basically. So then we end up with 5,850. Again, accumulated depreciation is just the same as depreciation expense in the first year, and we take our beginning book value minus our accumulated depreciation, and then the beginning book value becomes the ending. The depreciation rate, we can just carry that all the way down, and then it's a little easier for the second year because we don't have to do it's funny that they're different formats, but it means the same thing. 2/5 is 40%. So then we're going to add our current year depreciation expense. Subtract, what did I do wrong? Oh, yeah, reminder, always go back to your beginning book value minus the current depreciation. So always beginning book value minus current. Just drag this down. You can do a lot of these just with the formulas. And let's see, so we dragged all that through. This thing has a 5-year life, so I think this one needs to be fixed back to the beginning book value. And that gets us all the way down, so to where, again, similar thing, always the beginning book value. But you can really get your formulas working for you when you do these depreciation problems if you're in Excel, and just kind of drag through. So one way you could do this formula better, where you wouldn't have to go back and manually adjust it every time as you drag down, is to go in and select into you want this cell to be the same for each of these cells below it. So you can click F4, which puts in $2 signs, and then it will lock this cell into place, but it'll move the accumulated down, which is what you want. For this first cell, you want this minus this. For the second cell, you want this minus the one below it. And for the third cell, you want this minus this one. And then the bottom, you want this minus any accumulated. So if you want to leave it so every time you drag down, it doesn't just keep going down these cells, that's where you put the dollar signs in and just drag it down. Okay, let's take a look at the next problem. On tab 10, we wrote check number 128 for $26,000 to purchase the machine. Now we're doing straight line. Estimated life is 4 years, salvage value is $2,000, and then we sold the machine on 9/1 for $22,500. Okay. And okay, so let's take a look here. This is on 1/1. So we bought a machine, and let's just get our asset account here. And then we paid cash for it, it looks like. So $26,000, purchased the new machine. And then, okay, so we had a full year's worth of depreciation expense. And our basic formula, 26,000 cost minus 2,000 salvage value divided by, we can just use full years because we bought it right at the first day of the year for the problem, and we're just doing the ending day of the year. So we don't need to break it down to months. At least we don't need to here. We will have to here. On 9/1, we sold the machine for $22,500. So now let's do the same, actually copying and pasting just to make this easy. And now it's a 4-year life, so we're going to do dividing by not 4, but 48 months. So we want to get monthly depreciation first of all. So basically what we're trying to do in this entry is update our depreciation before we record the sale. And so 48 months, and then in this year we had, looks like 8 months of depreciation to record. So we've got that done. And now, with the full amount of depreciation that we recorded, here would be 10,000 of depreciation to date when we sell the thing. Now we're gonna sell. So we have cash coming in. We have 22,500. Giving us. Oh well, yeah, okay. We're not done yet. I don't know why this thing's telling us right away. But we want to get rid of our accumulated depreciation because the machine is gone. So we want to kind of wipe the whole thing out here. 10,000, that's what we had recorded to date. And then we want to record, let's see what else. The cost of the machine is gone, right? So the whole machine is everything related to the machine, including the asset account and the cost, is all gone. And so you can see we originally had 26,000. We had depreciated it by 10,000, so it was a $16,000 net book value at the time of sale. So if we take 22,000 that we got in cash minus the 16,000 that we were paid, to sell the machine, and versus the net book value of 16,000, we made a gain of $6,500. And this will be gain on the sale of equipment, or gain on sale. So really you just need to figure out, whenever there's a sale, you have to make sure that the depreciation is fully up to date, and then compare the amount of proceeds that you get from selling the machinery, and that will determine whether you have a gain, or you could have a loss if you had received less in this instance than the $16,000 net book value, which is the historical cost less the accumulated depreciation at the time of sale. Okay. Let's take a look at some ratio problems here on the next tab. So we need to calculate net sales first of all. I wish I could get the link up here. It's a real pain. Oh, okay. So remember our net sales is our sales minus our sales discount minus returns and allowances. So I'm going to copy this formula over, and then we can just update it. It's already got the structure in there of the formula, so that's helpful. So I'm just going off of what's above. Okay, and then let's see, gross profit margin, or gross profit margin. It's not wanting the gross profit margin ratio here necessarily, but we're just taking the total here minus COGS. Again, I'm just going to copy these over and then update the specifics of the formula. So for the new COGS each year, for the different COGS, and the net income, okay, we're just taking gross profit minus the operating and other expenses. I'm not going to copy the formula on this one because it's so easy. There's only one number to update there. Okay, now average total assets is going to be prior year plus current year. I mean, or you can do current year plus prior year, doesn't matter which order you put it in. And then we just divide that by 2. So here we had 950 plus 1050. Perfect. Okay, and now gross margin ratio is going to be our gross profit. Divide that by our net sales. So that's the formula we can just put in and go over there. Profit margin is going to be not gross profit, but it's going to be net income divided by net sales. Our asset turnover ratio then is going to be net sales divided by average total assets. Okay, and then our debt ratio is just going to be our total liabilities divided by total assets, so total debt divided by total assets. So 630 divided by 1050 in the first problem, or the first year, I should say. 665 divided by 950. Oh, what happened there? 665 divided by 950. No, not minus. There we go. And then the last one was 840 divided by 1050. So you can see our debt ratio is going down. Generally, that's a good thing. And let's take a look. Okay, is your company's gross margin ratio better than the industry average of 30%? So our gross margin ratio is not better. We're a little under 20s, mid to low 20s. Is the profit margin ratio? No. Is the asset turnover ratio better than the average? No. And is the debt ratio riskier than the average? Yes. So, I mean, it doesn't mean your company is going to go under tomorrow or anything, but you might look at these benchmarks and say, our margins need to improve, and we have more debt than average when it compares to assets for others in our industry, etc. So, a little scary. Okay, let's work on the last couple problems here. And okay, straight line. We're going to do a sales problem here, a selling of assets. And so, we purchased equipment is what we purchased, and we paid for it with cash. So we're equipment down, cash up, 37,500. Okay, and then we're recording a year's worth, or sorry, not a year, but let's see, what do we have? 8 months of depreciation, I think. So January, February, March, April are all not depreciated. So yeah, that would be 8 months of depreciation in this first year. And let's see, what did we get here? Let's do our formula. So 37,500 minus the salvage value. It's interesting that this, why does it show up twice? Let's read this. Salvage value. Huh. I don't know why that shows twice. I think that might just be a typo or a little error on the problem, but that's okay. All right, so we're going to have, it's an 8-year life, so 8 times 12 is 96, I think. I might have to double check my math on that. Plus 8 times 12, that was right, 96, okay. Oh shoot, I lost my formula. Okay, anyway, let's do that again. 37,500 minus the salvage value, divide by 96, and that would give us the number, per month. And as I mentioned, we had 8 months. So the first year gets 3,000, and then the second year is going to be very similar, except not 8 months, but we can just put 12 in there as an easy way to update that formula. So it's a full year's worth instead of just 8 months, it's 12 months. And the nice thing here, is we can just keep kind of using the same formula because we already have the months in here. And so in this problem, we're just going through January, February, March, April, May. So 5 months into 2023, or the third year, basically. We have, what did I say, 5 months, right? Yeah. We've depreciated 5 months in, and then we sold it on that 5-month date. And so we're getting cash. We're going to get rid of our accumulated depreciation. We're going to get rid of the actual equipment. And we're going to record a gain or a loss. So let's put everything else in. Excuse me. So 26,000. Yeah, we know. It's when it gives you an error right away. And then we can just, actually link to the accumulated depreciation that we've recorded thus far, just in these other cells. All of the 3 of those to date. And then the equipment was just the original historical cost is gone. And so now you can see, so the equipment cost was 37,500. You had 9,375 of accumulated depreciation recorded to the time of when it was sold. So $37,500 cost less $9,375 accumulated depreciation means that the net book value was $28,125. So the cash that we got was less than the net book value. So in this instance, we would have a loss on the sale for $21.25. And that's because, again, the net book value, or the equipment historical cost less the accumulated depreciation, was worth more. That was $28,125. This minus this is $28,125, but you only got $26,000 in cash. So since the cash received was less than the net book value, you had a loss on the sale of that equipment. Okay, so now we've got some amortization problems. Very, kind of similar, generally speaking, to depreciation problems. Typically, we're always using straight line. And when we're looking at amortization of these intangible assets, as we call them, we're going to want to be looking at doing straight line over the shorter of the useful life or the legal life. So it's a little bit of a different idea or logic than a depreciable asset, as opposed to an intangible, a physical asset versus an intangible asset. So we need to look at the problem and see if it tells us what's the useful life or the legal life. And things like, a patent or something can have a legal life, but a useful life could be different, right? So anyway, let's look at the problems and see if we can get through these. So on 6-1, we paid $10,000 to purchase. So we knew some cash. So cash was paid, and it was $10,000. So let's put that in first. We kind of know that right off the bat. And we purchased Small Co., which had accounts payable of $2,000, AR of $1,000, and equipment worth $4,000. And so let's go ahead and put these all in. Oh, does it like it? Let me see if it wants it. If it wants this in, yeah, AR. Okay. I think it likes it with a certain structure in terms of debits with alphabetical order is the word I'm looking for there. First, so we bought this company. We're the big company. We bought a small company. And so when we took on that, we bought that whole company and we're buying everything out from them. We have their accounts receivable now. The customers will pay us. We have their equipment. We own the whole thing. We assume their liabilities, like we have to pay their debts essentially. And I think it wants that. Yeah, accounts payable is going to be here. And we bought on the debt that they have, so we have to pay their bills too. We got their assets. We are the company now. Essentially, we're all just one thing, or it's a subsidiary. We own it, etc. And then we're going to use this account called goodwill to represent the difference in the amount of cash we paid versus the value of the company's assets. So if we were looking at this thing just in its equity, right, it has assets of $5,000 and accounts payable of $2,000. So remember our basic accounting equation: assets equal liabilities plus equity. And so if we were to look at this company of Small Co. on its own without considering what we're paying for it, the $10,000, the assets are $5,000. Remember, assets equal liabilities plus equity, or another way to say is assets minus liabilities equal equity. So 5,000 minus 2,000 would mean that we had 3,000 of equity, but we paid 10,000. So the amount over the equity that we paid is the goodwill. I think it was 7,000 then. So it's, again, goodwill basically represents just, kind of the the intangible value of this company that you're willing to pay. Because when you buy anything, right, and a business included, the price you pay is not just the equity that the accountants would tell you are on the books. It's really the value of what you, how you value the purchase, right? So that amount could be anything. Cash could be $1 million, could be 10,000, whatever the difference is, though, between what you paid versus what the equity on the books is shown as this concept of goodwill. Okay. Let's see. Yeah, let's see if there's anything else to talk about there. And just real quick, in terms of goodwill, it doesn't amortize or anything. It just sits on the books related to these purchases, and it gets reviewed on an annual basis. And if there's a decrease in the value of that goodwill, a significant one, then you could write that amount down. You wouldn't write it up necessarily, but if the value goes down, then you might have to account for that. But I don't think we see a lot of problems, work problems, at least it has that factor, but something to keep in mind. Okay, then we bought a song that we're going to use for advertising. And so when it comes to songs and advertising, that is what's known as a copyright. Make sure I get all my intangible assets there, and we paid that, so it's $60,000. I bought this one. I guess that makes sense. Kind of funny, but and then let's see what else we want to do here. We paid $3,500 in an attempt or in an effort to develop a new drug, and so there's another type of. Whoop, did we do it? Oh, we did not attempt. We attempted to develop the drug, but we did not finish the development. So it's not yet fully a patent because it was not a successful attempt, I guess, if you want to think of it that way. So we just write off the cost because we didn't actually succeed in developing the new drug. It was in the effort of it. And then we record an adjustment for the song on 12/31. Assume the author died 10 years ago. So the copyright extends from the life of the creator plus 70 years. So if it was the life of the creator, so his life is now that the songwriter's life is over. We had the life plus 70 years. So now we're basically amortizing this thing over, and we'll say accumulated. Oh yeah, I think we just go directly to the copyright if I can find it. So this one, remember, we don't use accumulated amortization per se. We just go directly to credit the copyright. But now, let's see. Okay, so the author died 10 years ago, and we bought the. What does it tell us? Our useful life? No. Okay, so we need to record an adjustment for the song. We bought the song. When did we buy it? On 7/1. And so we've had it for how many months? July, August, September, October, November, December. Okay, that's 6 months, right? We've had the song. And so we're going to take our copyright, and the total number of months that we need to amortize this again was the life of the creator plus 70 years. And so we have now, and did we copyright this thing? Yes, we got the copyright, purchased the rights, life of the creator plus 70 years. So what, we have 60 years. What's 60 divided by 60? So it would be 1,000 per year. Divide that by 12 to get per month. And then I said we had 6 months in that first year, right? So it's a little confusing, but take the cost of the copyright, or what you paid for it, divide it by the number of years left after the creator's death, but it's up to, with the max of 70 years, but 10 years have already passed, so we have 60 years now. And then dividing by 12 just gets us a monthly amount for that. And then we multiply by 6 because there's 6 months in this year, because we bought it on 7/1. So from between here and here, there was 6 months. So kind of confusing. You're not going to see a lot of problems like that on the test or the work problems, etc. necessarily, but it is something good to know. You might see a multiple choice question that has something kind of similar to do. So, all right, that's the last tab for us here, and appreciate you all following along. Thanks, and I will talk to you all soon.